Right now, we want to talk about the latest moves in the market, including yesterday's big sell-off. Joining us right now is a credit expert. Sheldon is partner and co-head of credit and markets at KKR. And Chris, you're talking about credit right now as being a non-obvious market. What does that mean?
Sure. Well, thanks for having me. Great to be here. Look, I think we've seen a big rally in the credit markets over the last year and into this year. And a big part of that is just growing consensus around inflation's under control. That what the Fed has done is working. And as a result, you've seen a lot of capital come into the market. In addition, you've also seen a lot of slowing of the fundamentals. So you have credit spreads tightening, fundamentals declining, in addition to defaults likely increasing. So as a result, it's just a lot harder and it's not as obvious. And if you look at a lot of the capital that has come in over the last year, not just the last year, maybe the last decade, a lot of it is like rules-based capital. So what does that mean? It's like a lot of guidelines, a lot of restrictions, a lot of parameters are put on that capital. That could be the type of assets they're able to buy. That could be the liquidity. That could be ratings. And as a result of that, what you're having is, as fundamentals are sort of slowing, you're seeing a lot more dispersion. And so what we're saying is, rather than, wear a jersey on your back that has one asset class, the best way to go tackle this market is being more nimble, more flexible, and bringing a multi-asset class approach.
Meaning this was a buy the rumor, sell the news type of situation. People have already anticipated that this next rate cut is coming and everything's kind of out of the way.
I mean, a lot of times the markets move a lot quicker than actual events happen. So right now it's not as obvious. It's a little harder. You have to be a little bit more creative. You have to create your own new issuance. And the more flexibility you have, the more ways you're going to win. And I think breadth and depth is going to win.
So what are some potential winning theories?
Well, I think there's a lot of dispersion in the market. So if you can be a little bit more concentrated, convicted in the public markets, there's places to actually get really interesting risk reward. I think private credit has been so much more focused on the senior secured part of the capital structure, the direct lending. But what we're seeing and where we're the busiest in the private credit markets is actually the asset-based finance. So the increased regulation on banks, how banks are managing their balance sheets and risk-weighted assets, we're seeing portfolios of high-quality assets that had never been for sale before.
Okay, so the pressure on the small and mid-sized banks means good news for other investors looking around the edges?
Absolutely, and I think it's a way to partner with the banks to be able to provide a solution provider. And I think if you can do that across multiple asset types, whether it be hard assets like aircraft to consumer portfolios, or even stepping into areas where they've stopped lending or reduced lending because of the attractiveness of the ROE, some of those areas like real estate credit. Right. Huge opportunity. But you have to have that breadth and depth, and scale is actually what you need to actually tackle it.
I hear your point that there are a lot of great assets for sale. Is the concern that you don't want to get trapped in something like a real estate play that doesn't make sense, maybe commercial real estate?
For sure. It's keeping it simple. We're still having fundamentals declining. So I'm not saying let's go into the distressed part of the cycle or buy a bunch of office real estate. But there's a lot of high-quality real estate assets out there that you can lend against that really the amount of capital that's coming into that market has just retreated. So it's stepping into places where it's attractive today, but without necessarily taking incremental risk.